Hi everyone, welcome to another of our broadcasts for our virtual ILS NYC 2021 event. Please visit the event website to view the details of our kind sponsors who help us to put on these events, and also to catch up on all of the video content which will be available there for you to view at your leisure. As we look at the development of the ILS market, always with one eye to the future, this year we're focusing on defining the next generation of the sector. It's a lofty goal, but with the help of experts from the industry, we're hoping to peel back some of the sort of layers of the industry and look forwards to see what's coming next. For this broadcast, I'm delighted to be joined by Cory Anger, Managing Director, and Liam Martens, Vice President, both from GC Securities, the capital markets specialist unit of reinsurance broker Guy Carpenter. Thank you both for joining me today.
Thank you, Steve.
Thank you.
So for this interview, we're going to discuss the next generation of catastrophe bonds, and in particular, how insurance-linked securities and the market can assume a larger role in insurer and reinsurer capital stacks. So Cory, I'm going to begin with you. To begin, the catastrophe bond market is already well established in insurance and reinsurance risk management. But how much of a challenge has it been over the last couple of decades to get to this stage where it's now truly accepted?
Yeah, it's a significant ask of a company to be a guinea pig, whether you're the first corporate, the first insurer, first reinsurer, the first public sector client to do something that they haven't seen before and take the risk that the market is going to be there and perform in the way that we think it could be there for you. Change is hard, and it's rare that change occurs rapidly without some specific spark or need that you didn't know you could live without. For instance, the iPhone. So the challenge of getting ILS to where it stands today in its collective form is remarkable, albeit it was a slow process starting in the mid 90s. Amazon, if you think about what their presence is in the market, became vital during the pandemic, but they took many years to gain online marketing mass versus dealing with legacy brick and mortar options. So in some ways, the ILS community is very similar to how you deal with it versus the traditional capacity concerns. But in the case of Amazon, it took them 4 to 5 years to even become profitable, and it took 14 years for them to earn as much profit as they earned in one quarter in 2018. That's truly transformative. I don't think you'll see the same mass of alternative capital potentially taking over or consuming so much of the aggregates insurance and reinsurance space, but it's complementary, it's additive. And so, with the exception of incidents of a material rapid change, incremental change is most common. And I would say for the reinsurance space, that's definitely the case. Early investors were cautious about not wanting to be the dumb money, providing risk transfer capacity too cheaply or not at an appropriate rate for putting out their capital commensurate with the risk. They also wanted to understand the attributes of the market and the risk itself, and sponsors were resistant to upending their existing and typically long-term relationships for new markets that were untested. Pricing was uncertain and commitment to the space was unclear. If we look at the early days of the market, it was supported by hedge funds, which typically are hot money. And so we started with risks that were perceived to be well modeled at the time, which was U.S. hurricane and U.S. earthquake, which typically are the most concentrated perils, typically on a non-indemnity basis and typically for a reinsurer. And it migrated over time to indemnity coverages, more meaningful for insurers and reinsurers starting in 2005, 2006. There was ongoing concerns for more than a decade about will they pay when an event happens? Will there be litigation when the event happens? And all of that was assuaged through, I'd say from 2010 to present as structures triggered, capital remained committed. I think competitive and stable pricing relative to traditional reinsurance attributes from long-term stable fixed income investors post the 2008 financial crisis accelerated the usage of these trends. And so now I would say it's broadly accepted by public sector, sovereigns, corporates, insurers, and reinsurers. It still may be new to parties, but it's not something where people question the model at all. They've seen it work and the value it brings.
Mm. And I guess the last few years has really been a good demonstration of that, with obviously losses, dealing with losses, paying out losses, communicating with investors, and then the pandemic in the last 12 months as well has also given everybody an education on the ILS market and the importance of it as well.
I would agree with that. I think one of the things that, and we see this in other sectors where when markets get soft, there's not enough yield being returned. I'm going to reach into riskier segments of an industry. So for instance, maybe I want more yield. So instead of going into investment grade, I'm going to go into the junk bonds. But then you're taking commensurately more risk. And so the expansion of from cat bonds into collateralized reinsurance and into sidecars is a reflection of one, expansion of application of the tool. So to get more access to more risk that may not necessarily come into the cat bond format given size and structure considerations. But there's also been an element of people taking on more risk, and that's a way of doing it. Now, the flip side of it is when risk losses start coming through, were the losses expected or unexpected, and how well was the models and the metrics that you use in order to frame and price and take on that risk. And so I think one of the things that's been nice about the cat bond market, we did an analysis looking over the last 20 years and really looking at the advertised or the expertized risk. The expected loss is very similar to actually the average impairments from major events over the last 20 years. And so I think that consistency of the market has attracted a lot of new capital in 2020 and 2021 as we're dealing with the fallout of 3-4 years of losses, as well as what does COVID mean in the new realm for insurers and reinsurers.
And that kind of comfort's really important. Thank you, Cory. So Liam, moving over to you. It seems we've gone from cat bonds being about securing access to deep capacity for reinsurance or retrocession, and now we see cat bonds as a risk management tool, a much more sophisticated approach to using them from cedents. How important do you feel this psychological shift has been?
Yeah, it's definitely been important. I think I wouldn't want to discount its role as still being able to provide deeper reinsurance and retrocessional capacity, though I think particularly these last kind of year to 2 years in the retro market and the sort of more heavy usage of index cat bonds have shown that ILS still has a pretty meaningful role to play, or cat bonds have a more meaningful role to play in that space as well, in contrast to sort of collateralized re-type structures. In terms of risk management, I think risk management has sort of always been inherent in any cat bond purchase, irrespective of more pressing considerations like upping front-end capacity via sidecar structure, or managing economic capital in the tail for a reinsurance player, doing an index cat bond. So it's always kind of been part of that. It's always been part of that framework. I think in the end, the evaluation that most people make in using insurance or reinsurance more generally is, do you have the capital base to sustain the losses that this instrument is otherwise replacing, and or are my shareholders getting fairly compensated for bearing that risk in the absence of any hedge? I think, kind of circling back to Cory's point and the discussion you were having with her, is I think you haven't really seen retrenchment from people who have been using ILS altogether, in the sense that people haven't used ILS, in the insurance and reinsurance industry, so the insurance and reinsurance companies, and said, actually, I'm kind of done with this altogether. I think you've seen people establish programs, cat bond programs, sidecar programs, and kind of maintain them through the ebbs and flows of the market. And so I think that's encouraging. And I think we're still a little bit on in the early days of seeing, other players use ILS capacity in that same way, be it governments, be it corporates. I think you've seen some government-like entities be more on the front foot on that front. You see some corporates, continuously come back to the market, but it's not to the level of adoption that you're seeing in the insurance and reinsurance industry. But I think there's future potential for that to happen.
Yeah, absolutely. I think everybody hopes for more corporate issuers and that sort of thing. We'll probably talk about that a little more later in the discussion. Cory, so deep capacity, that's really what the cat bond was designed for, so people could get access to peak peril capacity in the insurance and reinsurance market, and then that moved to perhaps more sophisticated risk management. And now, do you think the next phase could be about the cat bond being used as a capital source within risk management to provide growth capacity, so providing elasticity and flexibility to a reinsurer's own balance sheet, and perhaps being used more like some companies might use sidecars or funds and that sort of thing?
I do see that. I see the next phase shifting from just, okay, I'm going to test it out, I'm going to have some participation in my program. So it's more from a utilization to get incremental capacity, pricing benefits in terms and conditions leverage, to seeing ILS as a form of permanent capital to be relied upon as capital sources for business evolution. You know, traditional capital markets asset classes go through cycles as well, where the equity markets may not be open for you to reload if you need it, and or the fixed income market is going through stress. And so there will always be scenarios where the cost of that capital may change. But I think what we've seen is that the stability of the capital being there. I also think it's really notable that when we look at the 2020 class of new reinsurer formations and what they're looking to do, many of them have started and are deploying ILS strategies at inception, along with capital sources that they may have raised from private equity, which is not something that you would have seen with any prior vintage classes of new reinsurers. They said they would have gotten the traditional platform up and running and then started to eventually leg into an ILS strategy. And I think many of them are saying, no, we want to start out with that money day one. We want to harness it and use it. We either want to manage it or deploy it, you know, depending on the relationships that they have with those investors. And so I think, you know, financial flexibility is critical. And I think it was highlighted from the 2019 to 2020, you know, indemnity-based retrocession crunch, where there's too few providers with ever-changing terms, and that has a material impact on the underwriting operations of reinsurers. And then that trickles down into the insurance market and into the corporate market. But, you know, other industries such as financial firms rely upon a broader set of financial tools than this industry does. And so to me, ILS can be a helpful tool, you know, whether it's in a cat bond or a sidecar format, to provide such financial flexibility and more permanence of capital. But, you know, I'll say that also that ILS can't really remain static. It needs to continue to expand the short tail risks and the structures that it can provide. It has limitations, and I really, at this point, don't see a way to remove certain limitations, such as a lack of reinstatement and a lack of need for finite commutation of terms. And so that's just going to be always the biggest issues with ILS relative to what the traditional market can provide, because they were never asked to isolate a dollar of their equity or surplus against each limit that was put up like the ILS market is. But I think that, you know, despite those obstacles, I think that to the extent that we can continue to help risk takers understand broader set of risks, is just going to increase the opportunities that ILS can provide in complementary terms to traditional capital sources.
Mm. And when you talk about things like reinstatements, I mean, do you think there have always been something that's been in focus, obviously, for cedents, but perhaps as cedents look to securitization as another way to secure longer term capital, do you think that focus might diminish slightly and people will buy cat bonds for a reinsurance protection on one hand, but then for a capital need on the other hand, and maybe reinstatements become less important? Or do you think that's always going to be something where there's a slight shortfall?
So, you know, in some sense, people say, well, I have a reinstatement. Why would I ever want to give that up? And, you know, my view is the positioning of the reinstatement. I think if you're talking about earnings level covers, where it's not, it could come out of a severity event, but you're talking about the losses that are probably more medium to modest type of events, and that you're trying to make sure that you still have good earnings as a result of it, or if there's minor impairments to your surplus, that you top it up, then I think reinstatements are valuable there. That's something that it's hard to say, go to the ILS for the frequency-based covers when we can't provide that, and there may be value there. And I also think that it's easier for any risk taker to take on that risk because there's a lot more volume of data, that there's more consistency. You don't see your standard error of your risk level change materially. It's really when you get to the mid and the severity portions of the program where I would say, yes, you may be getting a reinstatement, but how valuable is that reinstatement at that point? Do you realize that you are compounding credit issues in the sense that you're going to pay a premium to a party that, depending on the magnitude of the event to their overall book, are they going to be able to pay on that second event if it were to occur, even though you've contractually gotten that? I think there's also issues from a regulatory standpoint. So, Canada and Australia are mandate that you must have one reinstatement, maybe two reinstatements within the cover up to very, very high levels. And I think it sounds comforting from a contractual perspective. The concern is going to be if and when you actually ever start utilizing the reinstatements at such level. I worry about the credit solvency concerns of the industry at that point. And that's where ILS, typically being fully collateralized, immunizes parties from that. I think it needs to be balanced in concert of over-reliance on reinstatements at the more severity portions of the risk spectrum.
That's really interesting. Thank you, Cory. Liam, moving back to you, if we think about covered perils and looking forward, do you expect the ongoing evolution of the catastrophe bond will naturally bring new lines of business to market? Is it just something that's destined to happen, or do you think there's a lot more work needs to be done in both education, I guess, and also perhaps around the structure?
It's kind of all those things you said. I think the ILS market, if you look back at all the different coverages it really has done, it has actually tackled quite a healthy amount of lines of business in its 20 some odd year history. There just hasn't been a lot of repeated uses for some of the more innovative lines of business. But I do think there, as Cory touched on, there's still a lot of room for growth, I think, in shorter tail lines of business. Maybe auto as a particular example would be one where there's just not a lot of activity, but if you can kind of be clever enough with the structure in terms of how it kind of all fits together, I think that could be an area where you could see growth. I think generally there are risks which are just still underserved and which this pandemic has magnified. I think, morbidity, mortality, critical illness, disability, all these risks are sort of shorter tail-ish risks that have the potential to be exposed to volatility and, catastrophic, occurrences where ILS capital just doesn't really play a huge role. And I think that's a credit to the traditional reinsurance industry in terms of how attractive, I guess, the products that they have been designing have been, and or the lack of focus from regulators and rating agencies on these types of risks. But I think that's an area where you can see some growth. And I think when you see the shakeout, whenever that will occur from various federal governments on the business interruption aspect of things from this pandemic, you may see transactions come out of that for specific corporates, larger corporates, or for pools or what have you. So that could be quite interesting. I think within the Insurtech space, there's a good opportunity. A lot of these players are more or less monoline insurance companies for the time being. They have very expensive alternatives to raising capital, and so reinsurance is the cheapest form of capital. They're growing quite quickly, and the reinsurance market has a natural limit to what they can, what support they can really provide to these companies. So these companies should entertain other structures that facilitate the access to the ILS markets and the capital markets, and help them optimize their balance sheets, because many of these guys sell themselves as capital light business models, and they're more or less entirely reliant on reinsurance to make that happen. So diversifying your sources of reinsurance is a natural path for them to take. And with the lines of business that these companies write, I think you'll see new structures come into play. And then, as Cory was touching on, you can't really get around issues on longer tail lines of business in a cat bond unless you have some very clever mark to model type commutation mechanism. But ultimately that's basis risk to one or both sides of the transaction. What you have seen, I think, is some form of a foray into, rated entities or sidecar-like structures for those types of risks that seem to be getting a little bit more traction these days. So it'll be interesting to see how that develops going forward.
And that's a lot of opportunity you just laid out. I think the Insurtech side is particularly interesting because, as you say, they're new companies, they want to be capital light, and to them it would make perfect sense to partner with long-term investors to provide them sort of their own, a bit more control over their own reinsurance as well, I suppose, as they're generally young companies with high growth strategies. Is that something you're seeing? Are you talking to companies in that sort of space?
Yeah, certainly. I think the results for different insurtechs has been a bit of a mixed bag in terms of their performance and relationships with reinsurers. I think many of the more mature, if you can use that word, insurtechs have kind of figured out the way they want to use reinsurance, and now it's, I think, optimizing within that way. I think many insurtechs sometimes want to use reinsurance because they see everybody else has used reinsurance, but they're sort of at the evolutionary life cycle of their company where it might actually do more harm than good to use reinsurance, just simply because they're a loss-making enterprise, and reinsurers will be clever enough to figure out a way to guarantee themselves a margin, sort of no matter what. So for those sorts of circumstances, I think insurtechs can be maybe a little bit smarter about how they access reinsurance capital, but for those in sort of the more medium to late stage, maturity cycles, while still being labeled an insurtech, I think are now at the point where they can entertain other structures than just the traditional quota share or something like that.
Interesting, thank you. Cory, we're looking at defining the next generation as the event is themed. Where do you think signals for sort of the next phase of the cat bond market's evolution are coming from? Are they coming from the risk side? Is it new cedents? Is it sponsors looking for new ways to integrate cat bond capacity into their programs? Or is it the investor side? Is it the demand from investors, which obviously we've seen elevated since the pandemic, it appears? Do you think that's the main driver?
I wish I could give a simple answer for, this is the typical signal that we see, and then we kind of rush out and meet it. But it really is a symbiotic relationship between sponsors and investors. And it's frankly, when both are motivated is when we see the evolution expansion occur. Who would have thought that short tail property centric liability or terrorism covers would have been assumed by the cat bond market 10 years ago? All natural peril covers were considered novel 10 years ago. It usually starts, I find, with the sponsor and their needs not being met. Either it's a challenging market conditions, restricted capacity, expensive capacity, adverse terms and conditions, performance or lack thereof after a loss event is a big catalyst. That usually sparks the conversation. You kind of feel like contractually I'm covered, and then you go through a loss workout process and realize, well, it didn't go the way I wanted. How do I fix this going forward? In general, it starts with pricing levels being reasonable to expand the coverage, smart structures, and the information that we can provide to investors to help them understand the risk, and helping investors assess the risk for the first time that they've done it. They don't typically come to us and say, like, I've been thinking about this space and help me deploy capital into this space when it's a new sector. It usually starts with, we have an opportunity that we then lay out the attributes and start to educate them. And it's a pulling them in. Like, is it a rational decision? And do the economics of the situation match up with how they could deploy it into parts of the ILS space where they know better?
So it's really a case of you match the appetite of each side together. Do you think there's a sign from investors that they're ready to deploy more at this point in time? I mean, we've had a very busy Q4 and people are forecasting a busy year this year as well. Are you hearing from your investor contacts that 2021 and beyond will be increasingly busy?
Well, we had expected it to be busy absent, kind of what's been going on since the start of COVID and the needs there. And it partly is because both in 2020 and as well as 2021, we're in high maturity years, which means the structures that were put in place in 2017 to that was the highest issuance year that we had, are now starting to roll off, and folks are starting to think about, how do I want to renew them, and then also reassessing the market. I think the challenge and the worry of how 2020 went and pricing implications that could happen for 2021 is playing into also that catalyst. I think the other fact pattern is really since summer, investors have been, there's been a lot of mandate shifting happening amongst the investors, as well as capital that said, okay, now I'm going to get better price than I was for the last several years. Is now a time for me to introduce capital. So they've had more capital come into the system, in addition to the de novo startups and their own ILS strategies coming in. So I think there is a significant amount of capital looking to be deployed. And that creates opportunities as it's being used. It's probably a little early to say how innovative 2021 will be, because they need to understand, okay, with this capital being released and all these, we're just starting on the issuance trends, how much, issuance is going to come through. But when you get that period of there's excess capital, that's an opportunity where we start thinking about, well, okay, there is this opportunity and this is how we frame the situation. Is that something that you think that could work? And that's when I find the investor base is a little more willing to spend the time to evaluate the situation. When their capital's scarce, they kind of go to the low-hanging fruit of structures that are simplistic, easy to understand, bread and butter, and less likely for them to have to worry about the unanticipated loss that they hadn't factored in their analysis.
Okay, that's interesting. So potentially with more capital on alert that it would like to come into the space, potentially that does drive a bit of innovation as well, I guess. Liam, when you talk about ILS and cat bonds becoming part of a broader sort of reinsurer capital stack, does that have ramifications for their accounting? Are there things that cedents need to be considering as they're looking at potentially bringing cat bonds into their capital?
Yeah, I think it's less of a, hey, this company's going to issue a bond and it's going to have a write down feature like a cat bond, and it's really part of the actual corporate entity's capital stack. It's more, I think, a way of thinking that has evolved in that reinsurance / ILS has always been a risk management tool, and if you sort of trace that through implicitly, it's a capital management tool because it reduces required economic capital that otherwise would have been funded by equity or debt, and reinsurance is just the better tool for that. I think the conversations that you're seeing these days is there's a more explicit line being drawn between the cost of reinsurance or an actual cat bond and what that other form of capital could look like. So I think it's, if you look at folks' investor presentations, like someone like an Axis who has as part of their capital structure in their investor presentations, the cat bonds and the sidecars that they have in addition to the debt and equity. I think it's that evolution of thinking in the way it's positioned externally that has evolved over the years. Another good case study on that would be Athene and their recent ACRA vehicle. The investor presentation they put together very clearly laid out sort of how they think about that vehicle as part of their overall capital structure. So I would say it's more of a method of presentation and communication than something that has substantively changed economically with reinsurance. I think the case where it's most explicit is, again, the Insurtech space, where there is it's not like reinsurers and insurers need to go issue debt and equity at all times to sort of fund their general business. They're usually kind of doing okay and making enough profit to sort of sustain the natural growth that they have, or they're retiring debt that's maturing by issuing another one. It's not as though they're sort of doing incredible financial engineering. But with the Insurtechs, there is a clear choice between raising more equity capital and doing something with reinsurance in terms of the required capital that the insurance entity has to hold, or there is a clear choice between doing some form of insurance-linked financing versus issuing more debt or more equity to finance growth. So I think that's where I see the relationship most starkly. But I think generally you're seeing a different posturing in terms of how these instruments are kind of positioned to external stakeholders.
Yeah, that positioning has become really clear in the last year or so, and yeah, you highlighted a couple of companies there, but people are certainly making it much clearer to their shareholders that they're utilizing multiple sources of capital for their reinsurance program, and the flexibility that provides them as well, which again, I think only bodes well for other companies noticing that and looking and exploring how they can do the same, which is positive. Cory, are there any sort of structural changes or innovations that you'd really like to see appearing in cat bonds over the next few years? Anything around the triggers or collateral types that you think the market could be exploring?
Well, one of the things that I find interesting is that there's been radical improvements in the design of parametric triggers. Entities that are focused on developing them, including within our own Guy Carpenter platform, and pioneering these parameterizations. And I think it's important for the acceptance that we're also seeing acceptance of such parametric products expand the application, particularly among corporates and public sector. So it's not just here's our one solution, take it or leave it, evaluate it against someone else's solution. It's the ability to design a solution, redesign the solution, evaluate across solutions that I think is very exciting. I would say that also what's exciting to see is the movement toward indemnity triggered covers for corporates. Because we'd always talked about in the context of parametrics with them. And while it's important because what they find that they can do is that they can cover losses that may be supplemented or excluded. And so they can apply the coverage, across all sources of losses that may come from it. And so that's the attractiveness of a parametric. But I think there's a number of corporates that say, listen, we want to make sure that we're covered for the losses that we've incurred, that we can, measure a model on. So I think the fact that we're seeing more indemnity-based coverage in the corporates is going to open up the market. I will say that we're going to need some U.S. tax reform to allow corporates to engage with offshore special purpose reinsurers to really meaningfully open up that market. The limitations on risk pooling and the requirements are actually impeding the ability for this market to grow. And I think it would actually grow faster if we didn't have those restrictions in place. And so I know that there's been efforts to, onshore SPVs, and I think if we can onshore them, that would help out with corporates as well. I think that investors would rather assume complexity of insurance risk that has low correlation to the traditional capital markets risk, rather than assume a higher amount of investment risk embedded into an ILS structure, because their main rationales for coming into this is that they want something that's got a lower correlation while still delivering a return. And so, if you want a higher return, they don't necessarily just need that to be funded, through higher, collateral returns that are embedded into the ILS structure, because it's a liquid, it's highly structured. They can go figure out how to lever the collateral return in other structures in their capital structure. So I really feel like for them to get a better return, they're focusing on the insurance risk and what's being brought to them. And it doesn't mean that it has to be simple structures. I think the evolution we're seeing is the broadening of complex structures as well.
And on the onshore offshore question that you raised, would onshore structures in the US also assist on the investor side for US domiciled investors, do you think?
I know that definitely there are investors focused on it as well. And so I don't think it affects every investor the same way, particularly, those that are offshore may not necessarily care, but operationally it becomes a lot easier for the portfolio managers that are already onshore to work in assuming risk. And then also it may attract more capital from US sources into the space. But I really feel like the restrictions that are put in place with withholding tax restrictions and ceding risk to offshore entities, and then not meeting kind of not clear guidance on what risk pooling is, has made it challenging. And so the transactions that you've seen from a corporate perspective, the market should be applauding the fact that we got them there, despite all of the tax considerations that we've had to go through.
Yeah, that's a great point, because they're important transactions, especially some of the recent ones, which are quite high profile. They do help to stimulate other interest in the space. Liam, the private cat bond market is a segment that's obviously largely out of our view, but what we do see of it, it's sort of bubbling along nicely. Do you think this is going to take a larger share of overall cat bond and ILS issuance in the future, or is it always going to be a smaller segment there for smaller entities, perhaps?
Yeah, I think you hit the nail on the head. I think it's always going to be more of a niche play. I think for nat cat risk, there's kind of a limited sweet spot for a true kind of private cat bond to take place. Many investors have their own collateralized platforms or use rated partners where and the brokers have their own operational flows in terms of how the placements are handled, where that market kind of runs quite smoothly. Once you get up to a certain size, the industry, I think as a whole, is kind of generally aware that 144A starts to make more sense. So there's kind of a narrow band in terms of sizing where a 4.2 instrument for natural catastrophe risk could make sense, and there's just not a whole lot of transactions that kind of fall into that bucket. I think simultaneously, a lot of the advantages that 4.2 transactions sort of have historically espoused, be it lower transaction costs or more liquidity, have kind of borne themselves out to be not 100% true. More liquidity to collateralized lower transaction costs to 144A. The more the private cat bond looks like, a 144A cat bond, with a proper indenture and, kind of cat bond like terms, you kind of may as well just do a 144A transaction at that point, because the complexity is comparable. You're sort of only saving yourself some disclosure requirements and maybe the cost of a modeling firm. And on the liquidity front, I think you saw with the events of 2018 and 2019 and the collateral trapping, that 4.2 deals didn't really outperform in that sense. They're still quite difficult to trade amongst people given asymmetry of information and the lack of dealer marks across a lot of those instruments, or volume of dealer marks across those instruments like you have in the 144A market. I think for non-cat risk, for those smaller players that you mentioned, I think it is still a valuable option, because many of these players are just not at the premium writing scale to justify or even support, a larger issuance. Ideally, as those companies grow and sort of become more aware of the market and what it can do for their specific lines of business, then maybe you would see a transitioning back into 144A. So, coming back to your point, I think, there's only 4.2 deals are only going to kind of be so good until the company outgrows their need, more or less. But they do serve a purpose, for sure.
And potentially quite a useful test sort of bed for new sort of risks and perils and that kind of thing. And I guess we'll continue to see ILS funds using them as a way to securitize collateralized re as well. So a useful way to be able to get notes that are more investable and more liquid. Cory, moving to you for the final subject. We've already spoken about the corporate cat bond a little bit, but given corporations becoming much more proactive in their risk management, particularly around climate exposures and obviously regulatory pressure on climate disclosure and all of these things, do you think this is really where the next wave of interest in using the cat bond structure for pure risk transfer may come from?
I do. I think the focus on climate risk, the reporting of climate risk and financial filings, they're helping corporates to identify problem areas to hedge. It's also causing corporates to understand and model the magnitude of such risks, something that they didn't always need to do or understand. And, the way that we speak about pricing in the ILS market is in the context of the measurable risk level. Many traditional insurance covers talk about pricing in terms of millions of TIV, which really doesn't tell you how much of that TIV is at total insured value is at risk. So, you're changing their understanding of their operations into a risk metric, and that risk metric currency opens you up to the ILS community because you're starting to speak their language, not just I've got total insured value infrastructure of X, without any context of what that means. I think also supply chain limitations, they've been seriously highlighted by COVID, and I think can only be exacerbated by the typical ILS risks. So I think supply chain management is going to continue to be a focus. I think, an item that, I think we've talked about indemnity coverage, being available to corporates, not just parametrics. So I think that that's a key notable item. But I would say that there's another topic that I think both Liam and I are pretty passionate about, in the sense that, I don't think that an answer to a problem is it's not hedgeable. And in particular, that's what the theme is that pandemic is not hedgeable, in the same way that wildfire was not hedgeable or terrorism was not hedgeable when they happen. In the moment, they may be very difficult because we're still trying to understand how it is that we can create solutions around it and get a discussion of the level of risk so that we can put price to the level of risk. And so I acknowledge that the capital need for pandemic-related solutions is going to be far greater than what the ILS market, or frankly, even the traditional reinsurance market can provide. But I would expect that there needs to be some thoughtful solutions crafted. And I would hope that the market can develop some alternatives and not just punt it solely to governmental budgets to resolve. I think that, the other recognition is when we deal with the corporate realm, their solutions are more earnings driven. When we deal with sovereign realm, they may be more severity driven, but then they're also looking for rapid response because they may be dealing with it so that they don't have to use other budgetary needs, budgetary funds, and shift them in the moment for emergency relief, et cetera. So I think that these tend to be multi-peril combined results, but that needs to be achieved. But overall, I'm just excited to be able to tackle these type of solutions. But, I would say with pandemic, as we get time and distance from COVID and get it under control, I think it's something that will, I think practices are going to change around the world, whether it's health practices and communication practices, in the same way that we're changing how we're dealing with climate risk, and hopefully with the U.S. rejoining the climate accord, that then, that changes at least the U.S.'s response in addition to what other nations are doing. But again, I think there's a lot of opportunities that the ILS market can help address.
Yeah, and the ILS market's always been very good at sort of solving problems for people, and I know there's been very collaborative efforts in the early days of cat bonds to get to solutions involving all parties around the table. And it seems the pandemic risk issue, a lot of it is the business interruption that people actually fear, but aside from the pure pandemic exposure. But it seems that ILS has been covering business interruption in some way, shape, or form using parametrics for its whole existence. So surely with the improved data, with these insurtechs coming along, we can find ways to at least carve out areas of business interruption to make them much more transferable, you would hope. Is that an area that you think the industry needs to put some time and effort into, not just around pandemic, but business interruption more broadly?
I do, and I think there's multiple ways that you can measure it. So, our first attempt at pandemic was more of looking at mortality effect as opposed to maybe morbidity or just simple business interruption aspect. But, is it something like the mobility indexes that have been created, and is that a way that we can use that as a triggering mechanism? And that actually can capture a lot more type of events than just a pandemic. So what are the areas that affect us when the mobility indexes see a significant impact? Is that something that's going to be helpful to tourism and transportation and all that kind of stuff? You know, you'd be surprised that a number of these industries had talked about solutions that would include pandemic and be broader prior to the pandemic happening, but they never actually bought the coverage. Now, the need is so great that it almost feels like a drop in the bucket what they would have bought, but it highlights the fact that your instincts were right about evaluating it. Your instincts were wrong about not proceeding and buying protection on it when you could have actually bought it. And so I think that there's a lot of opportunities to create these solutions. Obviously, our risk takers are going to be evaluating it differently than maybe they would have 5 years ago. But that's really the nexus that Liam and I are at in helping navigate that teeter-totter between the two interests and coming into line where we're balanced and we have something that meets both markets.
Absolutely, and that's really important at this stage. Look, thank you both very much. I really appreciate your time today. It's been a pleasure talking to you, Cory and Liam.
It's always a pleasure, Steve. Thank you.
Thank you.
Great to see you both. I'll talk to you soon.